What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 5 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into these charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do, we finally got something slightly different. It's a red inverted hammer. Important distinction that it's red because, of course, we know that the sellers stepped up at the highs of the weekly range and they pushed prices back down to the opening print. It's a red inverted hammer, so they went through the opening print, extending the weekly range to the downside, and were able to close prices at the lows of the weekly range. So from the structural perspective, I would certainly argue that the sellers do have the upper hand here, which is a change in tone from what we've been experiencing the past number of weeks here. But there's always two sides of the same story. When we tie in location, has anything dramatically shifted to the seller's perspective or advantage? Not really, right? So on the bar to bar count, we do still have a higher low. We also have a higher high. If we think about the weekly trend, and remember last week we talked about the weekly trend reversal, we still have a higher high. We actually made a new higher high, right? So that is important for preserving or continuing to reverse this weekly downtrend back to the upside. What's the next reasonable thing to be looking for? Ultimately, a higher low pullback. Now, with this structure, the inverted hammer, we're of course on the lookout for that higher low pullback. Now, what is the critical level that we've been discussing for the past couple of weeks? It's really right here. A couple of reasons as to why this is so important. Not only was it prior support, then prior resistance right here, it could turn into a break, retest, hold for support, also a higher low, and then move back to the upside, right? We would, of course, have to reevaluate the chart when and if we get to this level, roughly around 415. We'll talk about the nuance on the daily in just a moment, but that's, a really, really critical area here on the weekly time frame chart, especially because when we tie in the volume profile, we'll also remember that it's a high volume node, right? So you remember that markets like to move from high volume node to high volume node, and this being the closest high volume node, it would definitely be reasonable to expect the market to continue to pull back under the low of the inverted hammer and try to find support at the high volume node. Again, roughly 415 here, and we'll talk about it on the daily in just a moment. One last thing before we go there though. If we don't get a picture-perfect scenario, because markets rarely like to give us the picture-perfect scenario, right? If we do not support here for a higher low, is it the end of the world from the weekly trend perspective? Not really. This is why I brought out the Fibonacci's. The 38.2 retracement is generally seen as acceptable pullback or ideal consolidation. So if we do move underneath this 415 zone, it's not the end of the world to build something out like this on the weekly and possibly get trend continuation in the future. That 38.2 retracement is at 405 roughly on the weekly time frame chart. And I would also point out, this is, getting pretty nuanced here, but if we bring out the moving averages again, we've rejected off the 50 SMA, that's the blue line, right? Also equivalent to roughly the daily 200 SMA. That shouldn't come as a surprise. But the gray line is the 20 SMA, and that is also tying in for confluence at your 38.2 currently, if the pullback is deeper and harsher than we expect into the upcoming week's worth of trade. 405.10 seems like a reasonable area where that could still produce a higher low here on the weekly time frame chart. So overall, we are on the lookout for a little bit of pullback here, some continuation to the downside based on this structure, but it's not really going to change the new uptrend that we're building on the weekly time frame. Let's drill on down to the daily and start talking about tradable levels into the upcoming week. I'll remove the fibs. We'll talk about those later from this perspective. But zooming in, one thing that I want to talk about before we remove that 20 SMA, which is the gray line. You'll notice it's tying in beautifully with the bottom edge of the weekly expected move. We're talking about weekly expected move here. And notice that if we pull back to the low end of the weekly expected move, not only is it the 20 SMA, it's also that 415.35 prior set of weekly highs, basically right here, and the high volume node. So you can clearly make the case that this is a very important area of the chart if we see continued pullback into this upcoming week's worth of trade. If we are contained within the week's expected move, the uptrend will be preserved both on the daily and weekly timeframes in what I would consider a quote-unquote picture-perfect scenario, pulling back into that high-volume node. So that's the weekly expected move. Obviously, to the upside, it's a retest of the daily 200 SMA, weekly 50 SMA, and also the resistance trend line coming in from the all-time high. Let's talk about levels now. I'm also going to remove the 20. It served its purpose, and I think it clutters up the chart just a little bit. But talking about the price action of the prior week, we mostly had balance, right? We really went sideways for 4 days before breaking down on the Friday session. And I want to talk about two clear shifts in tone on the daily chart. So the first one was Wednesday when we actually opened on a gap down underneath Tuesday's bar. We dribbled a little bit lower but filled the gap, spent a majority of the day trading in Tuesday's range, and then closed ever so slightly underneath the low of Tuesday. It does not strike me that stronger sellers stepped up on that shift in tone when they were presented with a gap down to take advantage of. Obviously, the next one was the gap down on Friday, where yes, there finally was a little bit of follow through to the downside, but it really was not that aggressive in the grand scheme of things. We did not even make it to the lower edge of the prior week's expected move, right? So what I'm starting to sort of point out and build the case for is that this is reasonable expectations of pullback at the highs, running into critical resistance, weekly 50 SMA, daily 200 SMA resistance trend line after we've been up aggressively for a number of weeks. This doesn't strike me as like doom and gloom selling that's hitting the market here, right? So that's what I would say about the shift in tone. Yes, we are carrying forward a slightly bearish stance now that we've closed underneath these 4 days worth of balance. We're looking for continuation ultimately into 415.35. We do have to get through the PPI gap close area, which is 420, but underneath that, yeah, there's room to pull back into 415.35, and then we would seriously reevaluate the charts when and if we get to this area. If we see a retracement and close back above 424 early on this week, incredibly bullish implication. Why is that? Well, if you've been around the channel, you know that this is a balance area. We have a look below and fail if we close back above 424. And in that case, we're always targeting the top end of the range. What does that give us? It gives us a reattempt at the resistance trend line at the daily 200 SMA off of a very shallow higher low pullback. Very likely that that is when those types of things tend to break off of the higher low pullback, when the structure would also support trend continuation in the direction that you're trying to go, right? So the look below and fail here would be an incredibly bullish implication and powerful look to the upside here in the marketplace. Yes, it's a little bit of a stretch. We don't have any sort of confirmation or indications of that yet, but I'm just pointing it out as a scenario, right? You get bears who get overly aggressive on 1 day's worth of pullback. If we close, again, keyword, if we close back above 424, game on back to the top end of the range, in my estimation. Again, the first look is probably for lower based on the shift in tone and closing underneath the 4-day balance. So carry that forward first, but have that scenario, the look below and fail, in your back pocket in case it starts to unfold, in the earlier half of the week. We'll, of course, update you on the Wednesday midweek market updates. So that's what I've got from a levels perspective, a psychology perspective. We'll quickly take out the fibs one last time here. Just as a reminder, from here up to here, 38.2 can still be achieved. That's roughly 405. We discussed that on the weekly time frame. And if you want to count the rally as really starting from here, the equal low, right? Then guess what? 38.2, where is that? Right here, another confluence of levels, the bottom end of this prior range, even shallower of a weekly pullback, right? Still well within the reasonable area of that high volume node. So overall, yes, we are looking for some pullback. Is it to be expected after a rip your face off rally? Absolutely, but I'm not seeing any evidence yet of stronger sellers who just completely want to send the market back down to like 370, these recent lows in here. Let's continue along and take a peek through our sectors now. These, of course, make up the S&P 500, so the S&P can only do what these are doing to some degree. The XLV, the healthcare sector, the second heaviest weighted component of the S&P 500, is going to be incredibly important to watch this week because we have possibility for a look above and fail on this range. Remember that it's kind of two ranges in one. We have the container bar here. All of this is inside bar, inside bar, inside bar. We finally break out and are pulling back. Now, we're not technically inside of the consolidation range. We did not close inside on Friday. So to me, it's not yet a look above and fail on the bulk of where the price action took place. So because of that, I'm willing to give it the possibility of a higher low and trend continuation. But if we start closing underneath 132.70, that's it. Yes, I will shift tone and I will say, okay, we should start to target the bottom end of the range here on the failed breakout and the rotation back down into the range 130.50. And that, of course, would be bearish pressure for the S&P 500 in this upcoming week's worth of trade. So it would support the thesis that, yes, we are looking for reasonable pullback if the XLV closes underneath 132.70. Second heaviest weighted component, really important to watch how we resolve this kind of area right here. Energy sector, lightweight sector, obviously more D for defensive, as we say on the channel. Not really great to see this holding up, neatly at the highs here on a breakout of this level. Now, the technical pattern makes total sense, right? Higher lows equal highs. It makes sense that we're seeing a break here, but the implication for the marketplace isn't great. We don't want to see this leading the charge to the upside as the XLV per se pulls back into range. That would be a recipe for the SPY to move lower. So let me clarify here, right? If the SPY is trying to move higher back to the daily 200 SMA and the XLV is moving lower on the look above and fail, but energy is what's powering the S&P 500 higher, this curve right here, that would be a red flag. I would not have the confidence in the market to be looking for breakouts or trend continuation if the energy sector is the dominant force pushing the market higher, whereas the XLV, the XLK, the XLF are moving lower, right? You want to see the heavyweight sectors, the risk-on sectors support the move, not the lightweight defensive sector. So just to tie it all back together, the energy sector does look like it can continue higher here on the breakout. We don't want to see the S&Ps rallying just based on a move higher in energy. Hopefully that made sense, wasn't too confusing. The same thing is going to hold true here in the utility sector. This is D for defensive. If this continues to make new all-time highs here and the S&P is rallying towards that 200 SMA, not an ideal look. You want to see these types of things cool off. They're defensive. They should be lagging the market, not leading the market. Next up, we've got the consumer staples. This too is defensive, but notice how this is just going sideways here in a range. It's not aggressively continuing to break out. It's not making new all-time highs. This is okay. This does not strike me as the end of the world. And clearly, there's a little shift here as well. We've got an inverted hammer on the Friday session, so a breakdown of these three lows would bring us back for a back test of the 75.66. Ultimately, yes, bearish pressure for the S&P 500, but fine for a break, retest higher low, and then nice, neat trend continuation to the upside. We'll see. Ultimately looking to reevaluate at 75.66, but watch the 3-day lows like a hawk. If it breaks down, bearish pressure for the marketplace, obviously. Real estate sector, break and retest underway currently. Lightweight sector, not going to spend a whole lot of time here. Even if it moves higher, it's not going to make or break our marketplace, so I wouldn't really lean on this one too heavily. Sure, the chart structure would suggest that we could hold up here for a higher low and see trend continuation, but again, not going to save the day if the other heavyweight sectors, the XLV, the XLK, are moving to the downside. Next up is industrials, as we infamously say, 7% of the S&P 500. Don't you forget it. Currently underneath the 4-day balance range here, just like the SPY really and the analysis we did there, looking for a bit of a move lower on the failure of that range. Is it the end of the world? Absolutely not. This one perhaps has been up the most aggressive on these bull flag breakouts here. Is it reasonable to look for a little bit further of a retracement this time around? Absolutely. It's not really going to jeopardize the trend here. And again, still only 7% of the S&P 500, whereas our other heavier weighted sectors are, at least 15% plus, right? So double what we just discussed in the XLI. Next up is the communications sector. This is where we're starting to get a little bit more concerned for neutralization / bearishness, honestly, in the communication sector. Why is that? Well, we had this double top, right? It broke. We got a beautiful retest. And honestly, this hammer candle that printed on Thursday, it was a hammer doji. It looked really good to get, a break up and over that high and do something like this into these highs. It obviously didn't materialize. We opened on a slight gap down or just right at the lows and honestly pushed lower underneath this prior double top. So this does strike me as a slight bearish pressure for the S&P 500. We know that communications have been lagging throughout this entire rally that we've been seeing. So it doesn't strike me as like this new, incredible insight that we have into the marketplace. It again is just more of a neutral to slightly bearish indication for the S&P 500. Overall, I would want to see 57 act as a line in the sand. If we're above that, if we're above the support trend line, fine. It's just not really going to be that bullish of a force for the market moving higher. Tech sector is up next, just like the S&P. Again, here is your balance area breaking down on the Friday session, looking for some reasonable pullback to possibly fill the CPI gap up. That's going to be at 144.79, 145 if you want to just round off there. Overall, again, a slight bearish pressure for the market, in the short day-to-day outlook, but does it change the structure? Absolutely not. You can clearly see that we're still well above all of these consistent higher lows. Can we put in a higher low here? Absolutely, and then see trend continuation. This would really only strike me as concerning if we started to break down underneath this prior set of highs here around 142. When and if that happens, yes, I will change my tone. But as of right now, we still are in a bullish uptrend, and there's no reason to be thinking all-out collapse just yet. Next up, we've got the XLB materials, lightweight sector. We're not going to spend a whole lot of time here. There's your balance area. There's the tool. Breaking down, pullback, yes. Move into the 78, sure, fine. We don't want that. We want this. We want this tool right here. There we go. Does it strike me as the end of the world? No. Again, lightweight sector, it's not going to make or break the S&P 500. Would it support the idea that the market might move a little bit lower if everything's kind of moving in sync for this pullback? Absolutely. It's just furthering the story here that we're expecting a reasonable pullback after we've been up aggressively and we've seen all of this range expansion to the upside. Next up, XLF, perhaps another heavyweight important sector, second heaviest weight that we're watching. Here's your balance area. Again, we closed underneath on the Friday session, so that does strike me as being a bearish outcome of this area. Notice that on the Thursday session, volume's incredibly light, that we didn't really do anything on Thursday, and then the sellers kind of take it home on Friday here to close this gap. The next question ultimately is, do we support at 34.61 the prior low end of balance here and resistance? If so, that to me is like picture perfect pullback. If we move underneath it, obviously it's bringing into play this gap right here, which would be a little bit deeper, but still ultimately does not change the structure. Low, higher low. Can we pull back for a retest of this breakout point for a higher low? Absolutely. Financials would still be in an uptrend. That number is 33.73. So overall, again, building the case that reasonable pullback and a little bit of continuation to the downside can happen early this week, but it does not change the structure out there. Next up, last but not least, is the XLY for the consumer discretionary space. This one breaking underneath the 2-day lows into this balance area from here. So I would say that this is more firmly a look above and fail, unlike what we had in the XLV, right? So overall, there's your low end of balance. It's pretty tough to pick out the exact highs. Maybe it's here. Maybe we're not quite all the way in there yet. But nonetheless, we're definitely underneath this breakout point where we got a little acceleration and this prior resistance from in here. So it does strike me as slightly more bearish than what we saw in the XLV, just on a relative basis. So watching for some continuation to the bottom end of the range here for reasonable pullback in the S&P 500. Overall, again, I think we can clearly see that the sectors are supporting the idea the market might move slightly lower earlier in this upcoming week. This is the ratio grid of sectors. This gives us an idea of relative strength and weakness, risk on, risk off. You can check out the video in the top right-hand corner to learn how to set it up. The top four right here are our risk on sectors. Notice that the XLK is hovering sideways. Does not strike me as a red flag. Could it see a pullback? Yes. Is it still above an upward sloping gold line, which is the 50 SMA? Yes. So this has to be bullish and risk on. The same thing in the XLY. We're not going to repeat everything. Still above the 50. Good. Bullish and risk on. XLV perking up on that slight move to the upside on ultimately Friday's session, right? It's the only green name on the list here and here. So, it's trying, but it's not really all there yet. This to me is still not there. So we'll put an X in this one. Financials back at the 50 SMA, but after a pretty impressive recovery of this downdraft from in here. So I would give this one at least this, maybe bordering on a small check mark. Overall, the risk on sectors are still fairly risk on, but starting to border back towards neutral. And I think we'll find the same thing in the risk off sectors down at the very bottom. XLP is still underneath the gold line, but perking up, right? That's not a great sign. The energy sector is still underneath the gold line, but perking up. Again, not a great sign. Same thing with real estate. Actually, this one strikes me as more fine. It's really just more sideways. But utilities back above the gold line and perking up a little bit. So again, this is not full-blown risk off. These things are not glaring uptrends, not doing like these massive moves to the upside here, but you can see how it's a little bit more neutral as opposed to purely a risk off look inside of the sectors here. Next up, we're going to take a quick peek at our TNX. Oops, where did the cursor go? There it is, TNX. And what I want to talk about here is a little bit more fundamental. Obviously, big gap up on the Friday news from Germany, right? Really, really terrible. I think it was the PPI over in Germany. Read there. Basically, inflation overseas is still way out of control, and the U.S. markets are pricing in that, hey, things aren't completely resolved. Even though we saw a downtick in the August CPI and PPI here in the States, it's not the case everywhere in the world, and the bonds are starting to price that in with a gap up in the TNX. So overall, we're still in the middle of this range. It doesn't strike me as like full-on panic mode yet, but if we continue to see aggressive pushes towards the top up here, over 3%, namely, which is 30 in your TNX, that's where I would start to be slightly concerned for the XLK taking a little bit of a hit there, right? We know that the relationship is as the TNX moves higher, generally the XLK and the tech sector will rotate lower with the uncertainty of higher rates looming on the horizon. Something that I would point out, though, just to counterbalance this and keep things grounded in reality, is here is our target rate probabilities for the September Fed funds meeting, right? Overall, you can see that the majority of the market is still pricing in just a 50, I say just, but a 50 basis point rate hike as opposed to a 75 basis point rate hike, which is really what caused the market to rally on the CPI news. So we're still good on that front, but there is starting to become some little bit of speculation in the bond market clearly here to the upside on this Friday gap up in the TNX. So just be open to the possibility that if this continues to rally higher, maybe it's an indication that the Fed won't treat us so nicely in September, and maybe they give us that 75 basis point rate hike instead of the 50 that everybody is expecting. I don't want to tell you this so you start trading based on this information. It's really just context and, keeping in mind these overall drivers of the market as a whole. So anyways, we've spent enough time here in the TNX. Let's move along to the VIX itself, which is the volatility index. What I want to start talking about is 2050 going to start to act as the new floor. Remember that the prior floor was here around this 15 handle, obviously with the sickness volatility. 2050, this obviously isn't the sickness, this is just the beginning of the year, but before that, right, 2050 was the floor during the sickness, and now it's starting to act as a potential floor again. I do think that there are major differences in how we've come down from these big spikes here, and namely here into 2050. This is obviously much different. You can just see based on the slope of that arrow, and also the structure that we've been discussing in the broad market as a whole is much more bullish, much different. But, if this were to perk up over 2050, it just supports again the idea that this kind of is the new quote unquote normal here in the VIX, and maybe we don't drift all the way back down to 15, and the market just is going to be content around this 2050 for some time. So something I'm just considering as we're really just going sideways and not aggressively continuing to move lower underneath this level that we've been tracking for some time. I want to do the same thing in the VVIX. The VVIX historically, we've always looked at 103 ever since the sickness onset, but if we just go out a little bit further in time for like 5 years, notice that this is kind of like what was the floor before ultimately the sickness in here kicked off 103 as the critical level. So are we just acclimating back to, normal market environments now that this sort of, thing has passed us here? It's possible, but I would like to continue to read into this as just something to indicate that no one is aggressively buying SPY puts. This would be much higher, right? And no one is aggressively buying VIX calls, right? So overall, it would still strike me that no one's positioning here for a massive downturn in the market. No one's getting leveraged to capture big downside in the market, which would indicate, again, stronger sellers just don't simply appear to be present in the S&P 500. So the VVIX is continuing to support that thesis that we've been building throughout the course of today's video. Reasonable pullback, not, big heavy sellers that are just driving this thing into the ground. Next up, let's take a peek at our market internals. This is where things actually flip to the bear side in a little bit more of an extreme stance, right? If we zoom in on this, there's one critical thing I want you to really focus on, and we'll talk about the overcorrelation on Friday in just a moment. But overall, we're usually looking at negative 300 million, positive 300 million as significant volume flows to read into. Obviously, Wednesday, check that box, big outflow. Friday, also check that box, indicating, yeah, there actually was some stronger selling, but again, I'm just not seeing it as like, To me, it's just long liquidation. We'll talk about a reason for that as well in the market profile in just a moment, but these aren't new money shorts. They just strike me as longs that are liquidating up at the highs here, consecutive, like a week's worth of reads that are all underneath 300 million. Okay, we've got to obviously read into that a little bit as new money sellers, but just a couple of days in a glaring uptrend does not strike me as the end of the world just yet. Wednesday, obviously big move to the downside in the advanced decline line, even more important on the Friday session, spending the entirety of the day underneath negative 2,000. Huge correlation in the marketplace to the downside, and generally speaking, that is not sustainable. So can we be watching for some snapback on the Monday session? Maybe, but what I think is more realistic and probably more actionable is to watch for divergence in our internals. So let me just quickly round out the tick, then I'll talk about that AD divergence. Obviously, Wednesday, big read, Thursday and Friday, big reads to the downside as well. So yes, there is some selling taking place across the marketplace. I'm certainly not trying to deny that there's been a shift in tone into the end of week. We've hopefully acknowledged that throughout the course of today's video, that yes, the sellers are starting to step up, but is it just reasonable pullback? Is it long liquidation? It would seem to me that so far that is the case. So what's the deal with the advanced decline line? And by the way, if you don't know what this screen is in the first place, check out this video in the top right hand corner. It's a tutorial on how to set it up and what it all means in the first place. But anyways, advanced decline line, here's what we're watching out for: a little bit of divergence to neutralize the scenario of overly correlated advanced decline lines. Here's what you're watching. If on Monday we open inside the midpoint of Friday's range and this is neutral here, fine. Corrected, no problem. We can move forward without any issue. If we do something like this, where we open inside and the advanced decline line is aggressive again underneath the negative 2,000, but the market's not going anywhere, it's just stuck sideways in Friday's range, we're going to have an issue on our hands, because this is telling us that across the entire market, people are selling things, maybe even becoming new money sellers, right? And if the SPY isn't going anywhere and then it finally perks up for maybe that look below and fail scenario we just discussed on the SPY daily time frame, then guess what? You're going to have one heck of a short squeeze on your hands, okay? So be mindful of that on the Monday session. What does the advanced decline line do, and what is it doing in relationship to where we're trading based on Friday's range? Just to say it one more time really briefly, if we're neutral in Friday's range and the advanced decline line is neutral around the zero line, something like this from Thursday, fine, no problems, decent reset for the market. If we open here on Friday neutral inside Friday's range, but the advanced decline line is way over correlated again to the downside and we're not getting any follow through, short squeeze may be imminent based on the lack of follow through, even with an over correlation, right? This is not sustainable for market conditions. You would expect some sort of snapback. So those are the market internals. Let's quickly take a peek at our market profile here. So again, one more software for you. If you don't know what it is, top right hand corner, I've got a video to sort of cover you on what we're talking about here. Friday session, let's talk about long liquidation. I mentioned that briefly just a moment ago. Notice how A period constitutes over half, or maybe not over, but about half of the downside activity from Friday. What does that mean? Well, again, this is long liquidation. If it was new money sellers trending activity to the downside, we would have had a market profile that was really thin and elongated, not something that accounts for a majority of the selling and then balance like a normal day's session. So what does trend look like? Let's try to find an example to the upside. This is a good example of a trend day to the upside. So if you could picture this inverted, that would be more of an indication that yes, maybe new money sellers are continuing to hit it or people are unloading in a more serious fashion. But the fact that all of this happened over one period strikes me as long liquidation again. So this is really healthy, normal market balance. And again, not most, but a good chunk, about half of Friday's sell side activity was just probably poorly located longs exiting their position. So again, this just sort of further builds the case that new money sellers aren't quite getting aggressive just yet. I don't really want to harp on these things too much. Maybe I'm losing some people in the weeds, but nonetheless, I find that as an important indication. The last thing I'd point out from the profile is a mechanical level right here, around 4205, 4200, which is roughly SPY 420, right? It's the prior pre-market high from the CPI gap up. It's the point of control from that follow-through day, right? It's the next day's overnight low, and then the prior low of day here, and roughly for all intents and purposes, the overnight low there as well. So 4205, very critical level here in the ES, 420 on the pullback, right? If we get there, oops, let's clear that up. If we get here and then turn around, that's even more of a bullish implication as opposed to what we were referring to as picture perfect in the SPY as a move into, whoa, that's a lot of time here from that VVIX chart we were looking at. Let's go with a year. That's good. So again, 420 is quite clearly more bullish than the pullback into 415.35. So that's what I've got for you in the SPY. I know this one has been, droning on here for quite some time. So speeding it up through the Qs. Obviously, a majority of the psychology is the same. This is a little bit more bearish because we've had multiple 2-day balances continuing to break down to the downside. Obviously, notice that your pullback for the bottom end of the weekly expected move is still above the prior highs in here, which keeps structure intact. Is it a little bit more aggressive than what we'd like to see, a pullback into 311? Absolutely. At this point in time, this would probably be where I would want to see the ideal pullback remain above. So fill the CPI gap up and then move back higher for something that does that. That would be quote unquote picture perfect. Put it in a textbook, whatever. But 311 ultimately can be achieved on the back test of this prior high set. To the upside, again, if we're going to experience a look below and fail, it's got to be a close above 327.50. Again, very, very granular with all of these levels. Perhaps the hourly time frame chart does a better job of describing this. But notice how bear flag on Friday. So yes, the first look is for lower based on that. If we break down under these lows, 318 is the first number underneath, right? But if we were to move back higher with that daily close above 327.50, you can see how we can rotate to this breakout point and then up towards the top right here. Okay, so that's why I have all these numbers on the chart here. And again, the hourly does probably a little bit better of a job coloring in on that. Overall, implications are for lower first, but if we do see a look below and fail, you have the numbers and the upside, to pay attention to for some sort of swing or reversal back to the upside, right? Overall, that's the cues. Continuing along, IWM Russell 2000, the small caps, risk on, risk off. This is one of these things that we watch here. Pulling back just, again, indicates to me completely that, yeah, we're in a little bit more of a neutral phase right now of this market reversal. Of course, being the risk on, risk off sort of indicator, of course, pulling back in an overall uptrend would be neutral. It's not full-blown risk off. It's just neutral, right? The trend here is still clearly to the upside. I would say, again, here is a multi-day balance. We've broken down. We should look for continued pullback, but you're watching this prior pivot high around 190.71. Ideally, remember in the past, we had discussed this 196.50 level from right here. Obviously, we're underneath that. So the next level would be here, but 190.71 is much more important in terms of forming a higher low. This would have been rainbows and butterflies. This is kind of like your line in the sand, right? You can't really afford much lower than 190.71 if we're scouting that higher low pullback. So overall, IWM, yes, looking for a little bit of pullback, but it's really just a neutral implication, not all out bearish. That's the broad market. Let's get into the core list. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, we'll hop right into Apple, keeping it very brief in the core list. This did not break down underneath 171 on Friday. It's still within its 4-day balance range here, which does strike me as being more bullish than the broad market. If we take out 171, you're watching for the support trend line to come into play. Could be roughly around 168 early on in this week session. Anything underneath that really nasty, right? If the market's just completely falling apart, look for the gap to fill underneath 167 down to 165 quarter on the upside, because this is slightly more bullish than bearish, right? Consolidation here, breakouts are over 175 to get to 179, your prior pivot high from in here. Next up, we've got Netflix. What's going on with Netflix? Really neutral in this box right here. We did print a hammer candle on Friday, looking for the trade over 250 still. We know that we've got about 80 points worth of range. You don't need to nail the initial entry over 250, because if we scrunch up the chart, we've got this massive overhead gap that we're trading for essentially when and if we start to get some acceptance within it. To the downside, I would only really be bearish on Netflix if we fail this prior breakout point around 228.13 from the bull pennant, which got us to the bottom of the gap in the first place. So neutral as long as we're above 228.13. Day trades fine, whatever. Bullish above 250. Next up, we've got Tesla. Stock split is around the corner here. When is that? On the 25th, so be mindful of that. In the grand scheme of things, yes, breakdown of 4-day balance right here did produce a move lower on the Friday session, but we've started to print a little bit of a hammer candle. So I'm watching out for early in the week. Can we recapture the 200 SMA? Can we get a move over the hammer high? If so, that triggers a daily buy setup. We've got higher lows in place. This is probably going to turn into a higher low if we get the breakout up and over 907, rotate back to the top end of the prior 4-day balance range. Over 935 roughly opens the door into 1,000. So there's two ways to trade it. Number one, a little bit more aggressive looking for this trade here. It's probably a scalp on the intraday. Number two is being patient for the higher low break of this 934 to get into 1,000. Bearish on Tesla if we start getting candle closes underneath 865.70, or we just can't break up above 907 in the first place. So neutral, bullish obviously, and more bearish underneath 865.70. Next up is Google. What's going on in the Goog, we filled the gap underneath us from in here. We've sort of confirmed a weaker looking chart. That's for sure. Obviously, this candle on the Friday session does not look nearly as bullish as what we've described in Tesla, Netflix, Apple, even just being in its 4-day balance range. Obviously, this is far underneath its multi-day balance range. And more importantly, look above and fail here on the daily time frame. So watching for continuation lower. Breakdowns will be achieved underneath 116.35. The target should be here. Daily 50 SMA at 113.85. And then the midpoint of this range, which is at 111.50. If it's going to rotate higher and if this is going to be a higher low, I would only really look to trade this if we get higher low confirmation back above the top end of the range here at 118.75. So really, Google probably requires a little bit more patience or just favor the downside for bearish outcomes. Next up is Meta. What's going on here? Obviously, the XLC we know failed its double top. This is back inside of this overall range. Strikes me as bearish. Inverted hammer / just upper wick on the Friday session. Failed backtest after closing the gap, right? So to me, look above and fail. Target needs to be the bottom end of the range over time. Watching for bearish setups, favoring bearish setups here inside of Meta. 166 will turn into a flush point that can achieve lower 162. Then the bottom is here at 155.65. Next up is NVIDIA. What's going on in NVIDIA in the chip making space? Here's a, more similar look to the Qs, I'm sorry, with two back-to-back 2-day balances closing underneath on the Friday session does strike me as a slightly bearish implication. Anything that remains underneath 181 quarter, looking for consolidation and legs lower into the 50 SMA or just continuation in the first place. Anything that then retraces, so think about look below and fail, right? Anything that retraces back above 181.25, look below and fail on the 2-day balance, I would at least target 186.64. These are probably day trades or scalps, from one level to another on the intraday early on in this upcoming week. The better long trade in NVIDIA is obviously waiting patiently for the break up and over 192 off of a subsequent higher low. You've got something that does this, higher lows, builds out as a pressure cooker top, and boom, over time, 192 can be of interest for longs. Next up, we've got Microsoft. What's going on here? Breaking down underneath this range into the gap on the Friday session. Didn't close it, but into the gap. So watching for lower first in Microsoft and then reevaluating what the reaction is at 283.15. Do we produce a gap fill reversal is the question. That's what I would watch out for here inside of Microsoft. If we don't get a gap fill reversal, so if there's no strong buying reactions at 283.15, yes, look for lower to the bottom end of this range right here at 277.29, namely because it was also the breakout point from here, right? We got a break, retest, and then higher. Ultimately, that retest could come back into play, 277.29. If there's going to be a move higher, I'm not really seeing any reason to want to get involved in this choppy range up here. I would really require patience in Microsoft for upside. Last but not least, we've got the mini beast. What's going on inside of Amazon? Really, really tough range here. Finally breaking down on Friday does strike me as more bearish than bullish. We know that I've been patiently waiting for a move underneath 137.58 to rotate back to the top of the earnings gap here. So I'm being patient for that trade. 137.58 is my number, the top of these prior 3 highs. Break, retest, and go. If we give it up this time, again, I'm looking for the rotation here to the top of the gap, 132.50. After that, of course, monitor for continuation into the gap. If it's going to turn into a look below and fail, that's fine. I wouldn't really want to get chopped around in this range. We know that the better long trade is patience up and over 144.85 and the daily 200 SMA for breakouts into these upper levels, namely 150. That's going to wrap up the core list. Quick reminder to hit the thumbs up button, the bell button, the subscribe button, all those buttons YouTube tells us to tell you about. And let's get right into these ideas. Keeping it quick in the spirit of time here. The VZ, Verizon, obviously 2-day balance in play with a gap overhead to be filled. Over 44.50 fills towards 45.25. Inside bar setup, so I'm not convinced that the sellers have any major upper hand. Otherwise, they would have continued on the Friday session. If it breaks down underneath 44, don't get me wrong, we're not looking for longs, but watching for upside first in VZ. Next up is SLB for Schlumberger, looking at an ascending triangle here. If we can take out the top end at 37.52, look left, really thin structure on the way down. I'll be monitoring for day trades to the upside in that general area, but I wouldn't call you unreasonable for looking for something to start to move towards this gap here around 40.50 or 41 on the upside as something like a swing. So that's SLB. Obviously, further consolidation wants to stay above your support trend line. Next up is MMM, Triple M, 3M products, break and retest with a hammer candle on Friday. If we take out the hammer high, looking for more movement to the upside, obviously dividend payout and big volume on the Friday session as well. If we see the move over the hammer high, watch for upside. I like that we have a reversal bar printing off of a critical area of prior resistance, which is now offering some support. So watching for upside in MMM, obviously dribbling down underneath and into this range does not strike me as bullish. There is no long trade there. Next up is BMY, Bristol Myers Squibb. What's going on with this one? You can clearly see we've got a breakout level here from this multi-day balance area. The reason that this one made the cut is look at what happened on Thursday. We breach all of these lows by just a little bit, and then Friday we rally back higher. So do you think that any shorts got suckered into this one here? I absolutely do. And if we take out these highs, I think we're going off to the races on a little bit of a short squeeze. I use that word very lightly. I'm not saying this is going to 100. I'm not saying this is going to 200. I just think it's added buying pressure up and over 75.70. Not really interested if it just chops around sideways in the range. Want to see a definitive break on volume. Next, last but not least, we've got ATVI, another implication based on some wicks. Do you think that there are some longs trapped on this fake breakout high from Friday? I absolutely do. If we take out Friday's low, also the hammer bar low at 80, looking for some rotation lower. Could we easily travel to here? That certainly seems reasonable. About a point to the downside inside of Activision. That could be achieved. Maybe even the 50 SMA, right? So monitor some for continuation, but I'm liking the psychology of this inverted hammer. That's going to wrap up today's video. If you enjoyed it or learned anything new, let me know in the comment section or by giving the video a thumbs up. Don't forget to share it with a friend as well. And we'll be live at 8:30 on Monday morning. Hope to see you there. Everybody have a green trading week.